I'm Rhonda Legge with ETF Guide. Great to see all of you. Be sure to hit the subscribe button as well as the comment section and let us know how you've been enjoying our programs. So I've got some charts I want to share with you on today's episode. We've got the big picture look here in 2023 at some key asset classes. You can see the runaway winner has been Bitcoin, up almost 112% since the start of the year. Some of those other asset classes like S&P 500 up 15%. And then commodities as a group are up about 5.5%, doing pretty well with inflation being stubbornly high. And then the two laggards, global real estate and bonds, down on the year. In terms of industry sectors within the S&P 500, we've got 7 up, 4 down. The leaders have pretty much been leading all year long, and XLC, XLK, and XLY are those three sectors up strongly, between about 25% all the way to up to 40, almost 42% for communication services. And then some of those industry sectors that have been laggards are utilities, consumer staples, and healthcare, what we would call all relatively defensive industry sectors. So it's been all offense here in 2023. This is a bigger picture view, 10-year chart provided by Dave Princess over at ETF Portfolio Management. This is a pretty incredible chart showing GBTC, which is a trust that is linked to a basket of Bitcoin, has gained almost 5,700% over the past 10 years, which is just incredible. TQQQ up, what is the number here? Up about, I can't even see that figure there, about, I think, 1,400%. So it's pretty amazing over that 10-year time horizon how well cryptos have done and trusts linked to crypto. Of course, GBTC is aiming to convert to a spot Bitcoin ETF. Will that happen? I've got some thoughts for you on that in a second. This is an interesting chart. This is a stock that was in the news, WeWork, which went public a couple of years ago as a SPAC. And this is a disaster. The company has an imminent bankruptcy expected, as reported by the Wall Street Journal. And you could say WeWork is anything but WeWork. We broke, we miscalculated, we overleveraged, we stink. And this is the type of risk that some of you have been taking in your portfolios, concentrated positions in individual stocks. And when it works out, sometimes it's great, but when it doesn't, it can really come back to hurt you. And this is just to give you context in terms of the types of losses that you sustain. If they are big losses, look how much you need to actually gain to recover. So when you have a 90% loss, you actually need a 900% gain, and that's just to get back to even. That's not even, you're not even getting ahead. And so it's very important that you always invest with an adequate cushion, or what I call a margin of safety. And you need to compartmentalize your portfolio, as I teach in my online courses, as I teach on this channel. You compartmentalize your portfolio into 3 sections: your core, your non-core, and then what I call your margin of safety. Your margin of safety is the safest portion of your portfolio, which has principal protection, liquidity, and zero volatility. This is the part of the portfolio that many of you do not have. This is also the part of the portfolio where many of you are very sloppy. You think that, well, it's just cash. Well, it's not just cash. It's insured cash. And it's not just putting your money in a money market fund and that's cash and that's my margin of safety. Margin of safety is permanent insurance, permanent protection. It's not temporary. It's not dependent on market conditions, none of that. So again, when you compartmentalize your portfolio into these different areas, you make sure that you're segregating your portfolio into different parts, then it's going to better protect you against negative outcomes like this, right? Because if you're not investing with the margin of safety, then what's going to end up happening is the potential for disasters like this spread all over to your portfolio instead of compartmentalizing those losses into just certain sections of your portfolio, like your core and non-core. So anyway, this is getting back to Bitcoin and cryptocurrencies. The Wall Street Journal had a great opinion piece talking about cryptocurrencies and the FTX scandal. They had to say that, and I thought this was fantastic, the SEC chief claims that cryptocurrencies are securities. This is Gary Gensler, and that exchanges and token developers must submit to agency regulation. But, and this is very key, a federal judge this year disagreed with the SEC. Yeah, the SEC lost that one. And guess what? Congress has not given the SEC authority to regulate crypto. So the SEC should stay in its lane. And of course, they continue to try to overregulate or be in places where probably they shouldn't be. And I once heard an old securities lawyer who's now retired. He once told me very simply, and it was a fantastic thing that I'll never forget. He said, "Ron, the financial services industry is overregulated and underpoliced." Great quote. We asked you, which of the asset classes or these asset classes are you totally and utterly avoiding? And I was shocked. 61% of you said you want nothing to do with cryptocurrencies. Next in line was bonds. I was really shocked that this many of you have a strong disliking for cryptocurrencies, also known in some circles as rat poison. And, Ron's 1% rule is, listen, 1% of your portfolio in cryptocurrencies, I don't think that's going to hurt you. It may even help the portfolio. It's just a very volatile ride. And as you can see here, this is probably a good argument in favor of why you should have at least, let's just say, 1% of your portfolio in cryptos, something. It doesn't even have to be cryptos themselves. Maybe you want to invest in cryptos via equities that have a strong tie to cryptos. But this chart shows you, I think this is a 10-year chart, showing Bitcoin and Ethereum up over 6,000%. Bitcoin close to 7,000%. You compare that to the triple Qs, which gained about 385% over the same time frame. Tesla gaining about 2,000%. So I think this makes a strong argument in favor of some cryptocurrency exposure inside that portfolio. And then this is another, when you just think about the backdrop of what's going on with the government, runaway spending, runaway debt. This is from the Peterson Foundation, showing that net interest costs are projected to exceed the previous high relative to the size of the economy in 2029. And this is really going to trigger some sort of, I don't even want to say crisis. Some are predicting that, but it's gonna trigger something. And what I see ahead is higher tax rates. That's coming. That's almost guaranteed. And so you can position your portfolio, obviously, from a tactical perspective. Some are expecting the dollar to get beat up, and that would be certainly in favor of things like Bitcoin, maybe even some gold. And the point, again, is to have proper, not just asset positioning, but also proper tax positioning, right? Because if tax rates are going to skyrocket, they're going to stay the same from now to 2026. After 2026, U.S. income tax rates we don't know what they're going to do. They're probably going to go up if Congress, they're definitely going to go up. Congress doesn't do anything. But the point here is that it's important for you to be properly positioned, not just from an asset perspective, but from a tax positioning perspective. Our Q4 Commodities ETP report has just been released. I've got a link in the description section below. You can get that. And then also be sure to join ETF Guide. We have a free membership that's available to all of our viewers. We want you to join us. We've got special invitations to webinars, as well as we've got online courses. as well as all kinds of other perks. So just become a free member. You can also get my weekly email note, which summarizes all the important things that I'm watching that I think you should be watching. So hopefully you enjoyed today's episode, and be sure to hit the comment section below as well as the like button. And for those of you that are new viewers, be sure to subscribe. We've got new episodes of Portfolio Makeover, ETF Battles, as well as First Look ETF coming up this week, so stay tuned for that. I'm Ron DeLegge. We'll see you on the next episode.